So profit's not real money, profit's not cash. What you need to do is make sure there's money in the bank to support that figure that's shown as the profit. So you're looking at the actual cash flow. So what you want to see are the Benjamins that have come into the company, basically. A company can be showing more profit or less profit than the actual cash flow. So how can that be? You could have a company that's got payments in advance for some kind of service, you've got subscription services. Something else that springs to mind would be Tesla. They're taking in payments, but they're not allocating them to their profit because therefore the artificial intelligence, and they're only going to use that money and process it into payments for the profit once they've released that artificial intelligence. The other thing that can happen is that they've collected in advance for an order they've not delivered on. There can be many, many reasons, and that's obviously a very, very healthy situation. The best business in the world is you get paid before you deliver your service or product. That's the ultimate business. And we can find that model in several places, but to get back to the theme, you want to be comparing net to net or gross to gross. They come by many names: free cash flow or net cash flow compared to the net profit or net earnings or net income. And then the gross figures like the operating cash flow or gross cash flow versus the operating income for operations, also known as gross profit. It depends where in the world you're from as to which name is used, but they're all the same meaning. What you need to be comparing is the cash flow to the net profit and seeing if they're very similar. It doesn't matter if they're slightly out, but you want something pretty similar, or like I say, hell yeah, if it's going way above that, and that's really good news if you can understand why and just make sure it's for good reasons, but it's hardly going to be for bad reasons, really. So that's the net cash flow or net profit, the operating cash flow, operating profit. And you always want to be checking what a business has in terms of cash in hand, what they've got in liquid short-term assets that are convertible into cash readily, just to know their situation. The way really I find useful to learn stuff is by either very, very easily memorable phrases and short stories. On the subject of cash flow, there's two very good examples. Memorable examples are good examples to me, and they're real examples of cash flow and the dangers involved with cash flow. So you've got, first of all, Robert Kiyosaki's surfer wallet story, Velcro surfer wallet, and then you've got Shoe Dog, the book written by one of the founders of Nike. And although Nike was making more and more sales each year, each month, and it seemed like it was skyrocketing, the actual business was not able to sustain itself because every time money came in, they were having to produce more and more goods, and then they had the invoices outstanding for those goods, whilst they had to pay out to manufacture the new goods. So they were very, very fortunate. They almost had a miracle. Generally, a business needs to make a profit to survive, but sometimes a business needs to survive to make a profit. And that was a business run by a professor of finance who was a CPA who worked for PricewaterhouseCoopers, and he still made that very, very basic mistake. Cash flow can kill you. Success can kill you if you're not managing the amount of actual dough in the business. You need to be able to pay your bills, and as I said at the start, the ultimate business is the one that, besides other factors, of course, but would include, if we had a dream list of prerequisites for a business, mine would include obviously no debt. It would include very positive cash flow, that they were being paid in advance for some kind of good or service, or at least on the spot. So, even when I had my own businesses, I soon learned that it was best to be in a business where people would pay us on the day, and I would never have an invoice outstanding. I wouldn't let anyone not pay on the spot for our services, so it's something that's very basic, but if you don't know it, it can really be lethal. And so read Shoe Dog, have a look at Robert Kiyosaki's little tale about cash flow with his business, and those should be two very memorable, easy to learn from stories that might help you frame cash flow and just see how you ought to be looking at it and paying attention to it compared to what a business is showing as profit. The other one, just to mention quickly, is a business that Warren Buffett and I, not together, but we both invested in, and turned out to be fraudulent, which was Tesco, which is a very famous, the biggest supermarket in the UK, and they were just lying about what their financial situation was. And it's interesting to look at their declarations of cash flows, declarations of what they've got in the bank and what the actual profits are. And then the other thing that I've been forgetting to mention, but it's already included in what I'm telling you to look at, but you can also look at what's the maximum outstanding time on invoices. Like I say, that's really reflected in the figures that I've mentioned earlier, but it's something you can just zoom in on as well quickly if you do want to. It's just nice to see that a company doesn't have many invoices outstanding that are over, say, 60 days. 90 days is getting a bit ludicrous. So it could mean that some people who were in debt to them have gone into some kind of crisis that they're not able to pay, and that money might be written off in the future, might not be recoverable. So it's interesting to note both how many and what quantity of money is outstanding past, say, 30 days. A business that really needs to extend credit beyond 30 days, why are they doing it? They're not in a very powerful position, or the management's just terrible. There's really no excuse unless you're plagued by competition. You've got to really get that customer by offering more favourable terms. To me, that's a signal that wouldn't pass my filters as a company that's really attractive, that's one of the great companies of the world to invest in. So that's worth watching out for too.